Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Jun-sok, professor of economics at the Catholic University of Korea. Professor Yang, thank you as always for coming on.
Happy to be here.
Well, let's start with our big story this afternoon, still developing, but the Bank of Korea cutting interest rates by 0.5% to below 1% now, just 0.75%. What do you make of this move, Dr. Yang?
Okay, well, Bank of Korea, I think, was stuck between a rock and a hard place. I'm not confident that the rate cut will do any good. Well, we saw that the United States had a massive rate cut, not only just today, but also a couple of, also on the early March. And in both cases, it seems like it did worse than good. When the Fed cut the rate on March 3rd, we saw the stock market fall on the next day. And then today, the U.S. market hasn't opened yet, but so far the U.S. stock market futures seem to have been falling by about 5%. So right now, the rate cuts are confirming that we are in a bad situation rather than making people confident that the governments are able to handle this crisis.
Yes, indeed. It does look like it's going to be a rough Monday on Wall Street. But the Fed's emergency rate cut rates are just about zero now, between 0 and 25 basis points. Tell us more about the Fed's decision. And do you think the U.S. is prepared, like other countries, to go to negative rates?
Okay, well, if we look at the Fed, it's basically used up all the traditional bullets. Only have they lowered the federal funds rate to between 0 to 0.25%, but they also cut the Federal Reserve lending rate. That's the rate given to banks, and they lowered that by 1.5 percentage points to 0.25%. And then, as you just mentioned, the previous story, there's $700 billion worth of quantitative easing, not only on short-term bonds, but bonds of all maturities and even private assets. And then this has not been mentioned too often by the press, but this is the one that really surprises me the most. It's that the reserve requirement for deposits has gone to 0%. That's usually 10% that the banks cannot borrow, but they have to keep in their safe or in the Federal Reserve for safety, and they've even lowered that requirement percentage to 0. Now, there has been a lot of worries that the banks have not been lending out money as much as it should. There has been some excess reserves that a lot of people were concerned about. Right now, it does seem like the Fed is expecting perhaps a credit crunch, so that they want the banks to lend out as much as they can, and they basically freed up the interest rates to do so. But what it concerns me is that if this doesn't work, and it's quite possible that we'll be in a chaos for the next couple of days, if this does not work, then the Fed really doesn't have that many bullets left. The United States does not seem very enthusiastic about going to negative rates. There has been some academic studies saying that the negative rates are not as effective as some thought at the beginning. So in a sense, they do have some weapons left. They do have some ammunition left, but the Fed has basically used up most of its traditional ammunition today.
Very interesting times we're in, Professor Yang. But with the Fed's rate cut, we see stocks in Australia getting crushed today, elsewhere in Asia as well. The Dow futures off by 1,000 points ahead of Monday's open. What's this going to do to the stock markets?
Okay, well, right now no one really knows because we're in a completely new territory. I would expect the stock market not to do well, at least for the next day or two, because as I mentioned, right now the rate cuts are confirming everyone's fears rather than giving the market confidence. And the United States, I think the situation is worse over there because there has been a lot of distrust on how President Trump is handling this crisis, and also the more and more facts are coming out that perhaps the coronavirus was spreading much more in the United States, but they just did not know about it because they didn't test their population fully. So they're going to have a lot of increase in patients over, I think, the next few days. The Europeans are also seeing a lot of increase in patients. So that's going to unnerve the market. What I'm really concerned about is whether there will be a massive flight to quality, so people will be heading toward the U.S. government bonds or cash or Japanese government bonds, which will have very contractionary effect not only on U.S. economy but also in Korean economy and global economy as well. I think what really can make a difference here is the fiscal policies of the United States and Korea. We'll have to see whether the fiscal policies and the medical policies, the quarantine policies, will serve to reassure the investors, in which case we might see the stock recover. But until people feel more confident, I think we're going to be in a very volatile, shaky few days.
It does sound like it. Professor Young, thanks so much for sharing your insights today. We appreciate it.
Thank you.